everyone. A very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. Today is an action-packed day right here on ET Now and on The Money Show. We're going to be touching upon a very interesting topic that we haven't actually all this while, and that's acknowledging the fact that I'm sure with this lockdown, this forced lockdown that all of us have found ourselves in the midst of, it is something that has led to a whole lot of you saving money. No more eating out, no more indulgences, no more non-essential expenses, if you could call it that. And furthermore, I think one of the biggest savers are those people who had plans of going abroad this year, starting a new academic year, maybe in the US, UK, Australia, what have you. But now, with those plans being cancelled, these students have all of this saving aligned with them. So, let's say if you do want to postpone your travel plans for next year, how should you ensure that you are parking your money in the appropriate manner when your time horizon is roughly about 1 year? That's what we will be discussing today on the show. And furthermore, we will also be talking about the latest rule when it came to the Supreme Court. Essentially, the Supreme Court, remember, had day before yesterday, said that regardless of whether the father of the daughter of a Hindu undivided family was alive or not during the 2005 amendment, which gave equal rights to ancestral property to daughters, they will be equal rights by birth, period. So ironing out any differences and that final nail in the coffin for any sort of gender inequality. However, we will take you through all of the possible litigations that could come up, past, present and future, post this Supreme Court ruling. So, like I said, action-packed day on the Lal Street, plus some tweaks when it comes to taxation, additional disclosures as always, and also we'll be getting you a gist of how your next food bill could perhaps be going up. Like I said, action-packed day right here on The Money Show. So without any further ado, let's kickstart the show by bringing on board our very first guest today. We have with us Brijesh Dalmia. Brijesh, many thanks for joining us today on The Money Show. Let's start off first by talking about these savings, right? And I'm sure it's going to be very difficult for a lot of our viewers to quantify that because, when you do, prior to the lockdown, when we would spend on indulgences like, movies at multiplexes or, those dine outs, many of us didn't really keep track of how much we are spending. So that's why all the more it's going to be difficult for us to quantify how much we managed to save by just staying at home, in these last 3-4 months. So Brijesh, let's start off first with a way that individuals can essentially sum up their non-essential expenses and to understand the difference between what would be essential, what would be non-essential, because we as well, or in the world of personal finances, step one of having healthy financial habits is understanding your monthly expense, your monthly budget.
Yeah, thank you so much, Mubina, for having me on the show. So you see, all of us have been able to save some money during the lockdown because of our discretionary expenses. And my suggestion is that, you should always have a budget in place, and every month you should look into your income and expenses. And if there is a surplus because your expenses are down because of the lockdown and because of discretionary expenses, then you should have a tracking system how much you spent less during the last month or few months, and then you should put that money in a savings account. So for example, the money that you save will not be a one-time money. So every time you feel that your expenses have come down, you should park that money in maybe in a savings bank account, because interest rates have come down, but savings bank interest is still good. And once you accumulate a good surplus there, maybe you can then do the asset allocation, and then you can put that money in a short-term debt fund or maybe a balanced fund. So the first thing is that to identify how much you are saving because of the lockdown, and keep a track of that. Add funds in liquid and short-term investment. That is what my suggestion will be.
Okay. Brijesh, now yes, the money that you save, like you mentioned, make sure that you're putting it in a savings account. But how do you, and I want to actually, before I do that, I want to talk to you about, students as well. Like I mentioned, studying abroad requires a lot of money, and many parents, many students may have saved up that amount of money in the hope that they will get to travel abroad this academic year, study abroad this academic year, and it'll involve obviously a stay of a duration of at least 1 year. So we're talking about savings in at least double-digit lakh rupees. So all the more one has to be careful of how you're utilizing this money that you have saved, because the amount is so big as opposed to these indulgences that you have saved on in the last 3-4 months. Students have obviously saved in a big manner. Now let's take two instances. One, if students have completely given up on any sort of dream, dream of going abroad, maybe because of the strenuous US visa rules, or just because they found better opportunities back home. And two, if they have postponed it by 1 year, which means 1 year later they will need this money. How do you advise they go about temporarily parking their funds in the case of the latter, and of course in the case of the former, how should they go about investing their funds, period?
All right, so let me first answer you the second part of your question. If the situation is that your travel plans and your education plan has only been deferred to next year, then you are going to need this money, and so this money has to be kept in a very safe product. You cannot take chances on this money because it is for sure that you're going to need this money. So while all of us want the maximum returns on our investments, but returns comes at certain risk. So my suggestion is that the amount you were supposed to spend today for overseas education, you should keep that money absolutely safe. And by safe, I means maybe a liquid fund or a short-term debt fund. If you're not very comfortable with mutual fund, let it be in the bank savings bank account. You will get 3.5, 4% returns there also. But one should not take chances in terms of investing anything which has an equity component or market-driven returns other than the debt funds. Because the moment you do that, and if your bet goes wrong, then funding option can be difficult for you for the next year. So that part is very clear. Stay safe for that investment, maybe in a savings bank account or a short-term duration fund, which might give you around 3 to 5.5% return. Coming back to the first part of your question, if your program is cancelled, if you think that you're not going to need this money next year also, and your study plan is now not in the radar, then you should identify your medium to long-term goals in terms of your asset allocation strategy, how much risk you are comfortable taking, and then you should invest this money as part of your overall long-term asset allocation plan. In that case, do not park your money just in the savings bank account or a liquid fund portfolio, because that will not give you good returns. Maybe in that case, you should consider a mix of asset allocation products like equity, debt, and maybe a part of it can go into gold instruments. So you have to identify how much risk you can take and which part of the money can be invested how long. So if you think that a part of the investment amount, so if you have, let's say, a 15 lakh or a 20 lakh rupees corpus, and you think that I will like to invest 10 lakh rupees for the long term, and long term means maybe 5 years and 10 years, you can then go for a balanced fund or an equity fund. But if your time horizon is less than 3 years or 2 years, then that money has to go into only a debt fund. So accordingly, you have to identify your risk profile, risk appetite, and then invest. You should take some chances here because your investment is gonna be a little longer than the second case.
Okay. All right. So identify your risk profile and also identify for how long you can keep this money away. If it's a long-term plan, which basically means that there's a portion of that amount which you're not going to need either because your plan to go abroad has been cancelled altogether, or for whatever reason, you could use a balance fund, you could use an equity fund to park that money so that it's not lying idle in your savings bank account, which now barely generates 2 to 3% or maybe even lower in case if it's a public sector bank. An equity fund or a balance balance advantage fund will definitely have better return potential. So make sure that you are parking it over there and not letting it lie idle, in a savings account. Even fixed deposits, in fact, for that matter, really don't do much in terms of generating an attractive or a lucrative rate of return. All right, Brijesh, let's look at it from the point of view back again for an adult or a parent basically who may have been saving up this money. If the plan is cancelled and obviously you're left with that much money, right, 10 lakh, 15 lakh, 20 lakh, before investing, would you advise they actually pay down any debt that they may be having? So it could be a home loan EMI, a car loan EMI, and if it's a bulk amount that's left behind, would you advise even prepaying some of the EMIs?
You see, this is a very interesting question, and the answer is not very straightforward. For example, all loans are not bad loans. So, for example, if you have a housing loan and you are paying an EMI on that, that is all right because you are spending that money on an asset. You are building an asset. So it doesn't really warrant paying it off just because you have some surplus. If you're not comfortable with any kind of loan, of course, you can use this money to pay off even your housing loan. So my suggestion is that if you have a personal loan, so the first target should be to pay off the personal loans, which generally is at a higher cost and higher interest rate. Apart from that, in terms of sequence, maybe the first is the personal loan, and then you can think about the car loans or some other loans where the interest rate is really high, maybe 9, 10, 11, 12%. A housing loan today is not very expensive. You get tax benefit and you are building an asset. So that should be done only if you are absolutely uncomfortable. So just don't rush to pay off your housing EMI simply because you have a lot of money at your disposal. You can think about your investment portfolio, park your investments into other earning assets, because if you have some amount of loan on your head, which is a housing loan, it actually works in your favor as a motivation to make more money, to put in more effort in terms of your job or your business or profession so that you can pay it off. So it really depends upon the risk profile as well as the individual thought process, how one feels with a loan on their head. So personal loan, yes, you should use that amount to pay off your personal loans, and anything which in the current market situation is costing you maybe 9% or 10% or upward of that. But if your EMIs are 6%, 7% or 8%, you really don't need to be very much worried about such low cost interest EMIs. So I will leave it open to the audience in terms of their own comfort level. I generally would not be very eager to pay off my housing loan because that is an asset I'm creating. Other loans you can look at.
It's a very interesting way that you've put it, Brijesh, that if there is a little bit of loan lying with you, I mean, a loan outstanding that you have to repay, if nothing else, it would actually give you a motivation to work harder and, to earn more money. So I like the way that you've put that as well, Brijesh, a very different way of putting it, it's just like an emotional thing as well, if nothing else. Brijesh, would your answer be different if, let's say, you have uncertainty with respect to your job position, with respect to, business? COVID-19 has obviously disrupted a lot of jobs, it's disrupted a lot of businesses. Would your answer then be a little different that, since you're a little worried about the flow of your income in the future, might as well, in order to avoid any default, try and pay off as much loan?
Yeah, so again, it is again a very individual question. And when I meet people having loans and they ask me these questions, so it is again very individualistic in nature. So I will try to answer this question this way, that even if you have uncertainty in life, in the short term or the long term, the amount that you have currently in surplus, which you want to pay off your loan with, you can still park that as an investment. You're not spending that amount any which way. So whether you pay off your loan right now or reduce your loan right now, or maybe after 3 months or 6 months when you actually have a limited cash flow or your income goes down, it doesn't really matter so much, because let's say that you have 10 lakh rupees at your disposal and your housing loan is 25 lakh rupees. So whether you pay it off now or in case your cash flows go down after 3 months and 6 months, then you can always use this 10 lakh rupees which you have parked in other investment vehicles to withdraw and pay off that loan. The only thing that you have to keep in mind is that if you think that things are uncertain in the near future, you cannot invest this 10 lakh rupees in a risky instrument which has a lot of volatility. So equity should be out of question. Maybe you can have 10, 20 or 30% into a balanced fund and the balance into a debt fund. So they will have lower volatility, and you will be in a position to withdraw that money in case of uncertainty and pay off the loan. But as I said, if you are absolutely uncertain, and because the perception of different people is very different, so I might think that I will use this for my investment and long-term goals. Some investors might feel it that no, I don't like loans and I have some surplus now and let me pay it off. So it is a very individual question, and but as I said, don't hurry up to pay your housing EMIs. Park your funds somewhere else, because you get a lot of tax benefit when your EMIs are going on the housing loan. So all in all, other loans can be looked at in terms of payment, but housing loan you should not be very worried about.
Okay, all right. Yeah, it's a very personal choice. It's a matter of each individual's perception, and that's the reason why there's obviously no simple one answer. Okay, Brijesh, of course, right now we are in the lockdown, so it's almost like a forced, clamp down on non-essential expenses, which is, I mean, in a way, great, right? Especially for those people who were more on the, on the prodigal side, or bigger spendthrifts. Even if, let's say, the lockdown was not there, we're hoping that very soon, India and the world will get back to normalcy as the vaccine as well comes. But I'm sure a lot of individuals have a lot of takeaways as well from the kind of crisis that the COVID-19 threw everybody in. What would be your takeaways? I mean, and how should individuals essentially change their spending habits? A key lesson, a key takeaway in terms of spending for individuals that this crisis may have thrown at you.
I think what you just said makes a lot of sense, and in the last 3-4 months, all of us have understood that life could be very simple and we can still go on. It is not necessary to spend so much of money we generally do on a day-to-day life. Last 4 months, we have been able to live quite comfortably, even if we have not splurged out, and we didn't buy clothes or didn't go to restaurants, and we could save a lot of money. So I think one habit one has to look at is that it is not necessary to spend so much of money on discretionary expenses the way we used to do in the past. So I, as an individual, believe that this spending habit of people will definitely change in the days and months and years to come, permanently for many of us, and for many maybe partially. So if you have been able to change your habit in the last 4 months and live comfortably, then probably you need to continue with this lower spending habit and increase your investment portfolio, which will only give you more comfort going forward in life in terms of achieving your other goals and passion, etc. in life. So my learning, and maybe most of our learning, is this, that life is pretty simple, and it is not necessary that we have to splurge so much of money we have been doing in the past. So a lot of saving can happen, and this is a good thing.
Okay. All right. Okay. We just have received a couple of questions and queries as well. But Brijesh, before I go to that, I just want to ask you, what is a healthy split between, essential expenses, non-essential expenses, and savings or investments of an individual's monthly income?
All right. So you see, if I say that on a ballpark figure, you have 100 rupees of income every month post taxes. So you have a net income of 100 rupees every month. And there are two situations. One is where you have a housing loan, and the other situation is that you don't have a housing loan. Generally, 30 to 40% of your money can go into a housing loan, because when you buy a property for your own use, generally people go as much as 30 to 40% of your monthly income on properties. That is actually not an expense. That is actually you're building up an asset for yourself. So that is also a part of your savings. So if you have a housing loan running on you, then my suggestion is that you should look at least 10 to 15% of your 100 rupee of income every month to be parked as a savings. So the breakup could be, you can spend 40 to 45% of your income as an expense, maybe 30 to 40% to pay off your housing EMI, and the balance 10-15% you should save for your future needs. If you don't have a housing loan, then I think you can splurge a little more in terms of your day-to-day needs, and you can think about a 50 to 65% of expenses on a day-to-day basis, on a monthly basis, and 30 to 35% of your monthly savings should be invested for your future consumption and future security. If you follow this number, you will be finding yourself pretty safe going forward in life, and no matter what your spending habits are, if you focus on your savings rate, that is good enough. So if you focus, no matter how much money you make, end of the day, if you have a discipline that you are saving 30 to 40% of your total income, this is good enough. So if your income drops, probably this percentage can drop, and if your income goes up, you are left with a little more discretionary expenses. So keep this number in mind. Around 30 to 40% is a good number, and with EMI, maybe 40 to 50%.
Okay, great. So there you have it. Just a rough guide given by Brijesh, which can at least help you all kickstart, on healthy financial habits. And of course, not to mention, every crisis does bring along with it its fair set of lessons, and it's important that you have some learnings from these crises. Otherwise, it's just simply something that hampers with your mental health, your physical health. Might as well get some positive takeaways as well. In this case, of course, Brijesh has very nicely summarized all the important takeaways, especially from a financial perspective. Okay, let's take on board some questions and queries from our viewers. Then we've received quite a few of them for you, Brijesh. So first up, we have Santu Mundal, who wants to ask you about what an investor should do if an equity fund underperforms for say 5 years, and that's the case even for some of his ELSS funds. So for example, and I'm assuming he has these funds which are underperforming. There's HDFC Top 200, HDFC Equity, ICICI Pru Value, ABSL Frontline. Then there are, I think, 2 ELSS funds as well, and all of these, according to him, are not doing well. They're underperforming. So obviously it's a point of worry, and I'm sure a lot of mutual fund investors are in Santu Mundal's boat as well, because the markets have not been doing well, especially if they're long-term investors. Brijesh, what would be your view?
Okay, so the word underperformance has to be looked into two perspectives. So your expectation, let's say your expected return is 12% and you are getting 9%, and so you say that it is underperforming. The other way to look at it is that the benchmark has given 12% and your funds are giving you 9%. That is also called underperformance. And the third thing is that your funds are underperforming as compared to peer group performance. So if you are, for example, investing in ICICI Discovery, which is a value-oriented fund, then you cannot really look at the broader benchmark. You have to look at the value investing benchmark and the related peer fund comparison. So my answer is this, that, and my suggestion is this, that you should be really worried when your funds are underperforming over 3-year period as compared to the benchmark. You should not be really worried that your funds are not giving you good returns, even if the overall index is going up, simply because the strategy of the underlying funds that you have invested in. And as I could see, SDFC Equity or SDFC Top 100 or ICICI Discovery, mostly these funds are on the value bracket. I mean, of course, the underlying portfolio can be a little different, but mostly these are not growth-oriented investment philosophies. These are value-oriented investment philosophies. And in the last 4 or 5 years, market has discounted all the value investing and has given premium to the growth stocks. So you cannot compare your investing funds which are value-oriented to growth stocks. So you have to have a diversified portfolio. Some of the portfolio could be into growth-oriented mutual funds, and some of them can be value investing. So you should be worried if any of these funds are underperforming their relative benchmark. And that also not if they are doing bad in 1 year or 2 year, but if in 3 consecutive years, if your fund house is not able to beat the benchmark, it's a clear signal to sell. But if just because you are not getting the desired return, it doesn't mean that you have to sell that fund. And in the current context, I believe that markets are so distorted that you should not just look at the number of, you should not just look at the performance numbers. You have to look at the strategy where you have invested. For example, in today's market, even large cap funds are doing very well, but mid cap funds are doing very bad. It doesn't mean that you have to exit mid cap fund because they are undervalued today and their relative index is bad. You have to compare whether mid cap funds in which you have invested underperform the mid cap index or not. If not, there is no reason to sell. So all these funds probably did bad, but the only number that you have to look at primarily is that whether your funds are beating the benchmark or not. If not, it's a signal to sell. Otherwise, you can very well continue with these funds, subject to the thing that you have a diversified portfolio. Never put 100% of your investment in only value and mutual funds or growth oriented. You have to have a diversified portfolio, and then I think you should do well.
It's just not the most wise decision to judge your mutual fund only because it is underperforming or it's not doing well over a certain period of time. There are many other factors as well, like Brijesh has flagged off. Okay, let's take on board one more query. We have Subramaniam Pichai, who wants to know your view on the banking sector. In fact, he's saying the banking sector is down 25%. So he actually is considering investing in banking mutual funds. So I think thematic funds as a topic is something that I guess will be a whole show altogether, Brijesh. But yeah, what is your view on investing in banking funds? And, you know, I mean, would you advise either an SIP or a lump sum in these banking funds?
So my first suggestion is that unless you are a seasoned investor, unless your portfolio is reasonably good, one should try to avoid sector and theme based investments. It's like a Chakravyuh. It is very easy to get in, but very difficult to get out. So unless you know the timing to enter as well as exit, it will be very difficult for you to make money in theme based investments. So when you invest in a diversified fund, you need to hold on for a long period of time. That's good. But when you invest in a sector fund, both your entry and exit has to be very well timed, which is very difficult. The second point is that if you're talking about a banking fund, almost all the diversified funds, whether you call a large cap or a multi cap fund, have 35 to 40% already exposed in banking. So the moment you buy 2-3 funds which are diversified, you already have a 35-40% of your total investment into banking and financial services portfolio. So it may not warrant for you to buy specifics of banking fund just because it is down by 20%, because the stock prices are monitored on a daily basis and adjusted in the NAV. My suggestion is that go with a diversified portfolio. Now, if you really want to invest in a banking fund, just because they are down by 25% doesn't mean that you should invest, because as an investor, you don't actually know why the funds are down 25%. Maybe they can go further down. And when during the March crisis, all these banking funds were down by 40-50%. So if you want to have exposure, keep it limited to 5-10% of the portfolio and invest through SIP mode or maybe systematic transfer plan. Don't just jump on to invest one time or lump sum money into a theme-based fund. That is what I would suggest.
All right, great. Well, Brijesh, we're all out of time, so we let you go on that note. Thank you so much for, guiding all of our viewers on their financial planning process, and at a great time, because all of them, or at least many of them, may be sitting on a good amount of savings that they have gathered up in the last couple of months, and more so valid for those people who've been saving for big ticket expenses like an overseas education. But speaking of expenses, speaking of, the key learnings that individuals have come away with from this crisis, Scriptbox has actually conducted quite an interesting survey on the very same bit. Let's go across to Karunya Rao for their findings on the Financial Freedom Survey of 2020. Karunya?
Scriptbox recently conducted a survey among 1,400 participants to assess their financial preparedness and to achieve freedom from financial woes. What are the steps they're taking and what are the key trends that are shaping up? 1,400 people were surveyed, among which 83% were men, 17% were women, and the results of the survey threw up a lot of exciting insights. In fact, it shows that nearly 45% of the people polled are uncertain about the economic recovery in the aftermath of COVID-19 and are bracing for at least a year of slow growth, which is reflected in their change outlook to personal financial matters. Talking about personal finance, then, we've got you some key highlights of the survey. How will Indians change their spendings? Well, a majority of them, being 28%, said they will be cutting back on non-essential expenses. 22% said they have an emergency corpus with them, and 10% said that they will be reducing their EMI burdens. About changing financial plans, the people who were surveyed said, 28% of them, that they will start having a financial plan. They'll start working on making one and follow it in times to come. 50% of the people surveyed said they intend to get external help for financial planning. So perhaps it's some good news coming in for a lot of wealth managers and brokers as well. 23% people said that they will start creating an emergency fund. 18% said they'll be looking to save now or starting to save for their retirement. 10% will be prioritizing on children's education and buying a house. Finally, what is the most common financial mistakes according to Indians and according to people which they tend to make when it comes to managing finances? 39% say it was not having a defined long-term financial goal, a big mistake that majority of people surveyed tend to make. 18% said it is poor savings, 15% each coming in for first investments with poor exit option. Another 15% of the people surveyed said that mixing life insurance with investment, another common mistake people tend to make. 10% said investing in exotic financial products. So these are some key takeaways of Scriptbox's financial survey and the survey on financial freedom. So let's see how the trends in the future pan out, but this is how things stand as of now.
All right, thanks so much, Karanya, for that. So yes, lots of takeaways, lots of lessons that this coronavirus crisis as well has taught us. We will do one thing, we will take a very short break right here on the show, but when we return, we will be doing a deep dive into the Supreme Court ruling of, or rather the clarification on the Hindu Succession Act, the amendment that was put in place in 2005. Don't go anywhere.